Hello, hello, hello. This is TDFA, Teach the Teacher Assignment Part 1. My name is Martin. Today we're going to talk about risk and return. Specifically, we're going to try to understand the link between potential gains and investment risks. On agenda today, we have key concepts. I'm going to talk about what is risk and what is return, and how different risk types impact investment decisions. And then I'll explain more deeply how to measure risk with quantitative data and how to know if investment is actually worth doing. So term risk refers to uncertainty of investment outcome, and return is a profit of your investment. And then when you combine those two together, you get a risk and return trade-off, which basically means the higher the profits, the higher are the risks, and it goes other way around too. So lower the risks, also lower the profits. And every time investor wants to purchase a certain stock, it should accept all the risks associated with it. And so there are four main types of risk. There is a market risk, also known as systematic risk. This one refers to the overall market and the correlation between the market and the singular stock, also known as beta. So if the whole market goes down, your stock will also go down, and that is the risk. Then there is a business risk, unsystematic risk. So this one refers to a singular company having some issues. For example, a CEO decides to quit one day, or the company faces some supply chain issues. The price of this single stock will go down, but the whole market mm, will stay the same, right? Then we have financial risk. This one refers to a debt of the company. So the company with higher debts will have a higher risk. And then inflation risk. So inflation basically means your money losing purchasing power over time. So if inflation rate is higher than return on investment, even if your investment made profits, when you convert it back to the currency you're using, you'll face losses. And markets usually reflect all these types of risks um, in the price investors are willing to pay. So when you go to the market, decide to buy an Apple stock, for example, uh, all these risks are already reflected in the price of Apple stock. And higher the risks, lower the price of the singular stock will be today, but higher expected returns. And I'm gonna explain more how to measure risk. So to measure risk of a company, you have to gather historical returns. This in the left corner, you can see historical returns for 11 days of a random company. Then you have to calculate the return for each day. And to do it, you have to take the price of the stock today divided by the price of the stock that was yesterday minus 1. And then, for example, for the first one, you get 0.011. And then you do it for every single day. It's easy to do it in Excel with the formula. And then to measure the volatility is the overall risk of an investment. You have to use a standard deviation of return of every single day. And then for this random stock, you can see that the volatility is 0.006. And to make it annualized, so per year, you take the standard deviation you calculated earlier, the volatility for 11 days, and then you multiply it by square root of 252. And then here in this example, you get 0.11. This means it's 11%. So the fluctuation of this single stock is 11%. It might go up 11% or down 11% in a singular year. So that is not that big of a risk. And to measure market sensitivity, a systematic risk, you can count beta. I'm not gonna explain how to measure beta. It's easy to just go online and check a automatically calculated beta of a company on random website. And then if beta is lower than 1, it means the stock will swing more than the market. But if it's lower than 1, it means it will swing less than the market. But it also makes it less risky and also less profitable. And then we have a risk versus reward, a Sharpe ratio. To calculate the Sharpe ratio, you have to find expected return. This can be calculated as average return for a single year, for example, of the company. And then you subtract the risk-free rate. Risk-free rate is usually a rate of a bond in the country your stock is located. So, for example, USA, you go to US Treasury website and calculate the rate of a single bond, and then you divide it by volatility rate that we calculated earlier, and you get the ratio. And the higher this ratio, it means the better reward for the risk you're taking. And conclusion. So in conclusion, I can say that understanding risk and return is essential for every single trader or investors because they have to deal with it every single day and they have to accept the risk and understanding how it works will help you make more informed decisions in future. So you have to learn it and apply. Thank you.